In this video, we're going to talk about Paysafe, trading under the ticker symbol PSFE. We're going to cover the price action over the past few days, the company itself, and the recommendations regarding buying, holding, or selling the shares. If you would like to see more stock analysis videos, please like, comment, and subscribe to my channel. But before today's video begins, I'd just like to clarify a few things about the timing when my videos are recorded, uploaded, and how much they react to the latest market updates. Those are prepared, recorded on the day before and scheduled for the next day. If there are significant and volatile movements during the trading day, they will not be reflected in the video itself. With that being said, to the extent possible, my analysis will be based on the medium term, or even the long term, and not necessarily on the intraday movements. The main reason why it shouldn't matter that much is because most people investing in stocks, or even just trading in and out of their positions, usually keep their positions open for at least a few weeks. With that being said, if there are significant movements in the stock price that happens afterwards, either they will not affect the overall picture, so in that case we will cover them the next time we're supposed to cover them, or if they are significant enough that they change the outlooks, then yes, I will do a follow-up video in the shortest delay possible with a reevaluation of what I think should happen next. Paysafe is a startup operating in online payments with branches of storage and payment products for both individual and commercial clients. It is the parent company for many applications like Squirrel, eCash, and NetTeller. Its offer of value is to facilitate users to exchange money online. The appeal to the market about the company is that Paysafe is a company with recent introduction to the stock exchange and therefore attracts a lot of attention, translating into higher trading volume and potential future performances. Its stock price is fairly volatile, which can provide excellent opportunities to make gains by selling at the right moment. Like many other startups from the same era, Paysafe seems to have a following online amongst retail traders who are willing to be patient with it and to even increase their investments into the company despite a decreasing stock price. The market cap of Paysafe is currently at $2.88 billion, and the enterprise value is at $6.52 billion. The market cap is the price tag financial market is willing to evaluate Paysafe stock at with consideration to its future potentials as well as the short-term fundamentals. The EV, or the enterprise value, is the net result of the company's assets once all the debts are paid back. Usually, the market cap is higher than the enterprise value, but sometimes there may be exceptions because the company may be highly leveraged or under a lot of selling pressures. The quick ratio of Paysafe is 1.12, same for the current ratio, and the debt over equity is 0.86. The average trading volume of Paysafe has been 13.92 million shares, and the daily volumes have been 8.2 million shares, 13.5 million shares, and 32.7 million shares. The one-year beta of Paysafe is 2.64. Its 52-week high is $19.57, and its 52-week low is $3.18. Now, let's also talk about the options market for Paysafe. In terms of volume and open interest, options market favors the call side. Generally speaking, the put options mean that the market expects a pullback. The calls options mean that the market expects the market to move up. And the key strike prices where there are the most interest are $4, $4.50, and $5. Looking at the market at the moment, I believe that Paysafe is on its way to find some significant support levels going forward. Now, some have mentioned how the market cap is significantly below the enterprise value, and this is a sign that the company is selling at a big discount. I would say that one major issue with this interpretation is that most of the assets is called goodwill. Goodwill means that the market has a lot of asset in the form of expectation that the company will perform well. Or in other words, You buy something at a higher cost because of the brand. That's basically what goodwill represents. This may count as an asset, especially when businesses are doing well, but when the business is struggling or has difficulties, or at the very least perceived as having difficulties, it may begin to impair, which means that not only the enterprise value may go lower, but it can also affect the profit. In the short term, I believe that the market will keep its selling pressure on Paysafe, but in the medium term, the company may see its stock performance back up. Not always because the financial results are back, but because at some point the stock may have run out of short sellers, or because those who wanted to unload the shares, hence the selling pressure, have already done so. Usually when this happens, the stock may keep going on like this for months. This is why I would suggest to have an expectation that the stock may go down for another 30 to 40% before there may be upward catalysts. In the meantime, I believe that Paysafe should see its risk profile updated. The current market context is not helping it because market is less and less favoring growth stocks, especially considering that Paysafe is not necessarily a growth stock either, just a stock in a fairly new sector and recently introduced to the market. I would recommend you to consider buying it when the market is showing us some support, like the one we've been having during the past week or so. I would recommend to allocate a maximum of 0.5% of your portfolio's capital to Paysafe, but if your risk tolerance is normal or lower, I would recommend to keep it at 0.25%. In the current market environment, I think that we should be careful about taking positions in the financial market in general, especially when it comes to equity market. Over the past decade or so, the financial market has been living with the help of newly created capital from the quantitative easings, which resulted in the increase of asset prices and the corresponding collapse of their yields. Of course, the low interest rate also contributed to reinforce that phenomenon because the financial sector would first of all see its profit margin squeezed, which will in turn keep the returns of other sectors low as well. At the same time, the market doesn't represent the real economy, and the real economy often doesn't get reflected in the prices of their own securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. And I want to say that fundamentals sometimes doesn't play that much of a role at all. If the asset prices only depend on the fundamentals, then their performances in Northern Hemisphere would have been more than mediocre, because things have mostly been stagnant over the years, ever since the last economic recession. A few things can explain why asset prices managed to remain high during these years, despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their local economies. But because that money is distributed to banks and expected to be loaned to businesses, and that there aren't that many opportunities in the real world, the money went into the financial sector to buy up assets. Of course, the QEs are wrapping up in many countries, so for the next couple of years, it's not going to be the main driving force to keep the asset price high. But it's compensated by the arrival of new capital from different regions in North America because it's still perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be a sustained phenomenon over the years to come. The last phenomenon is the creation of artificial bubbles that are either supported by the real market trends or completely fictional to allow market participants to play the game of hot potato and to either generate profit or to safekeep their capital. Of course, the people who end up with the hot potato lose money, but that's another story. The EV sector in 2020 is an excellent example of this. Nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially in Asia. This means that the market is expected to see its volatility increasing over time, which will provide opportunities to make a profit or to incur losses depending on the timing and risk management of those portfolios. Another thing to note for this period of time is to be very careful with having short positions. Usually, it's already more risky than having long positions because losses are not limited. And with the increased involvement of retail traders, I believe that the stocks being shorted will have a higher probability of getting squeezed, and this will occur randomly, which will result in potentially massive losses. We're also observing very often people will choose to rush in positions not necessarily because the fundamentals are convincing, but because there is a buildup of demand in a specific stock and that people will pile in to ride the gravy train with the rest of us. This kind of behavior is highly risky and may result in heavy losses as well. It's worth pointing out that in 2020 and probably in 2021 as well, the financial market has never presented that many opportunities, but it's also during this period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. The positions should also begin small so that there is an opportunity to average down later. Typically, the growth stocks would take about 5 to 10% in my portfolio overall, and each and every one of them represents maximum 1% of my portfolio. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.